the first thing that I wanted to make sure to highlight is that in the presentation here, we're really going to be talking about as COVID becomes endemic, right? So we're not under any kind of false pretenses that COVID is going away or that it's under control or that it will somehow be cured all of a sudden. I think it's generally accepted that COVID will be essentially endemic and we'll be living with it for quite a while. So as we get started here, I just wanted to thank some of the organizations who have helped us in RVA Works along the way. One is the Virginia Department of Housing and Community Development, who invited me to come to cover this particular topic. I also wanted to highlight Capital One and the Ewan Marion Kaufman Foundation for their continued support of our work here in Richmond. So, what has been changing in the world of entrepreneurship? First thing to highlight is that we saw an incredible spike in new business formation rates. And if we look at the dark blue, that's high propensity, which means a propensity to employ other people beyond the founder themselves. The lighter gray area are lower propensity, where these are businesses that have been identified as a solopreneur or two founders coming together and starting up a business and less likely to hire future employees. So I'm not going to hit you with a lot of facts and figures, but I do just want to show some of the trends that are out there and how this is leading into some of the opportunity sets. Next, it's not just in the United States. So this is also happening. This particular graph came from The Economist, where they looked across the OECD club of higher income countries and looked at the same sort of rate of new business formation across Finland, France, Germany, Italy, Spain, and the US. So in many different economies, this is happening. So one might ask, well, why is that happening? And when we look at some of the work done by the Kaufman Foundation, we'll see that a lot of the business formation was done based on opportunity, right? So we have opportunity and necessity, right? Opportunity is all about, I want to build a business because I see this opportunity in the market and therefore it's worth pursuing. Necessity is more like, I've lost my job, I need to replace my income, and I need to start a business or do something in order to replace income. So when we look at what's happened, we can say, well, first off, a lot of the growth, that spike, has been based on both opportunity and entrepreneurship as well as necessity entrepreneurship. Then we saw a tail off in 2021, not as low as 2019, but it did tail off. And that's to be expected because we saw this huge spike. And part of that tail off, the predominant factor was that more people were going back to work. And as they were going back to work, some of those necessity-based entrepreneurial opportunities became less relevant. Next. So why did all this happen, right? Obviously, it happened because of COVID, right? So we went through this period of short, sharp shutdown. For our organization here in Richmond, we responded in a couple of different ways. First, we stopped in person. Second, we continued our services and had everyone shift over to Zoom meetings. Now, the good news in all of that was that we did not see a lot of issues around the digital divide. What we had were students and volunteers working collaboratively all on Zoom. Now, as this happened, and as we saw, and I think all of us saw, the fiscal stimulus push, right, that happened during COVID, whether that was anything from some of the Main Street lending program at the Federal Reserve, or we could talk about the Paycheck Protection Program at the SBA, the EIDL loans at the SBA, but there was also a lot of push in terms of personal payments that came out through, it was toward the end of the Trump administration and then into the Biden administration, we saw this push of cash. So what's ended up happening? The first thing is when we think about the effect of what was going on back then, the first thing to keep in mind in terms of context were supply chain disruptions. So incoming finished goods and intermediate goods and commodities, those shipments were disrupted, right, because of COVID lockdowns. And when there were lockdowns, they ended up rippling through supply chains. We were also impacted because of what was happening overseas in some foreign markets which are exporting into the US. So you'll remember the ships that were out there, waiting to get into port, right? So huge disruptions in terms of logistics and supply chain. Now, what ended up happening as well was that we had this two-part aspect to inflation. So one part of inflation we call cost push inflation, right? So what that means is just simply that the things that I'm buying are costing more, therefore I need to raise my prices. Cost push inflation was a part of the dynamic with the supply chain interruptions. Also, we had a less factor, but part of the factor is something called demand pull inflation. So here we think of demand pull inflation, it's sort of like if we had, let's say, we were playing Monopoly and everybody got twice as much money as they currently had, and now we start thinking about what's going to happen with the value of the properties, and everybody starts bidding them all up. That's demand pull inflation, when people have more money and they're willing to pay more for goods and services. So all of that was happening, and we saw this inflationary pressure, and then war broke out in the Ukraine. At this point, it was not only the fact that we had the supply chain interruptions that were COVID related, but also, and arguably a little bit late, in terms of the monetary policy to tighten up the supply of money. So all of this unfolds. We go into what's currently a humanitarian disaster in the Ukraine. And as this happened, we had supply chain disruptions, mainly in the energy markets, liquefied natural gas, other oil exports, also fertilizers. Ukraine is one of the largest, most significant wheat belt areas, right? And so because of that, we're expecting an increase in terms of the commodities and foodstuffs. So what does all that mean for entrepreneurs, right? Because we've just gone through quite a few big picture factors: monetary policy, fiscal policy, labor, cost of inputs. Well, the first challenge for entrepreneurs, whether they're Main Street businesses or whether they're someone who's interested in a tech business, tech venture, and wants to raise venture capital, either way, the cost of capital is going up. So as the Fed raises rates and reduces their bond buying, we're going to see higher costs of capital across the board. That'll be in mortgages, auto loans, consumer loans. And here, this is just to show what's happened over the last year. And we see that large green bar shows where businesses used Paycheck Protection funding and paid down balances on commercial and industrial loans, right? So there's been a pay down, a large pay down of funds that were borrowed previously, which is great. That means that a lot of small business owners are not particularly overextended at the moment and hopefully are in better position in order to weather the storm with a higher cost of capital. The next graph that I wanted to show you here, which I think is also illustrative, is that the red line here is the 3-month Treasury rate, right? So this is the rate that the Fed is charging banks on 3-month Treasuries, and the blue line is of loans, right, with an interest rate floor. And so what we're seeing just over the last couple quarters, you see, is a slight uptick in terms of the cost of capital for small businesses. This is likely to increase because of the stated goals of the Federal Reserve, which include 7 25-point increases in terms of the core inflation rate, right? So think of roughly all the interest rates costing 2% more than what they do today, right? That's where we're headed. Next, challenge 2 is about input costs and the availability of inputs. So we've heard about different dynamics with supply. We've had different challenges around baby formula most recently. We can also expect supply issues around fertilizers, potassium, phosphorus-based, potash-based fertilizers because of issues in the Ukraine. And this bar chart shows some of the impacts of input costs and availability. So the long light blue line is one that many people may have already heard about, which is used cars. Right? So there's been a large increase in the cost of used cars. So we can imagine that for Main Street business owners, for entrepreneurs who need to have transportation as a part of their business, this is going to be an increased cost. The other is related to energy. So if we look down the list, energy commodities, fuel oil, motor oil, gasoline, energy services, electricity, right? So we're seeing a lot of price increases there as well, which is to be expected when we have first the COVID cost impact on supply chains, as well as a restriction in supply based on what's happening in Eastern Europe. Challenge 3, finding employees. So as we know, we've gone through something that has been dubbed the Great Resignation, where a lot of people left work early, took early retirement, did not go about seeking necessarily a new position. So we've seen, this is U3 unemployment from the Federal Reserve. And so we can see that unemployment spiked hugely during the lockdowns, which was to be expected, and then has significantly tailed off as well, going back pretty much to where it was before the pandemic. So there's not that many people out there looking for work, and we've seen that in lots of different ways. Closely related to this are wage rates. And so when we go around to a lot of different retail stores, we'll see help wanted signs, we'll see hourly rates posted. In this area, we've seen them 15 to 18 an hour, right? So entrepreneurs can expect, number one, to find it more difficult to find employees, number two, difficult to retain those employees, and number three, difficult in terms of maintaining wage levels that are appropriate to the regional trends. Next is pricing. So when I put up this chart, sometimes my students start getting shivers. So don't get too nervous. We're not going to delve into it too much. But this is simply to say, in an inflationary environment, it's really important to raise prices to keep pace with what's going on in the market. Now, we have this whole trend around demand elasticity. We don't want to raise prices too high or else we start losing business, but we don't want to keep them low because then we leave money on the table. So that's why it's important in an inflationary environment to keep track with what's going on in the market. And this particular graph shows the optimal price. So I'm not going to get too much into the academics of that, but what I want to say is it's just very important for entrepreneurs to monitor their price as they, particularly over the next 6 months, because inflation currently is running about 7.8% in the consumer price index, as an increase over last year. So how do we support entrepreneurs with all of these different challenges? We've gone through a lot of macroeconomic factors, We talked about monetary policy, fiscal policy, the environment for labor. We talked about demand and pricing. And so we're going to talk a little bit about existing entrepreneurial activity. So as we know from what we just saw, there's already all this business formation happening, even though interest rates are increasing, and even though it's tough to find employees, people are still forming businesses, which is a good thing. And so we can imagine organic growth. Now, when I talk about organic growth, I tend to think of this as a spectrum based on how intensive the business is for using capital. For example, if a business uses less capital, and here we can think of freelancers, people who are doing personal services, home health care workers, right? We can think of professional services, so accountants, attorneys, insurance brokers, and so forth. So those businesses that are less capital intensive will be less affected by the increase in interest rates. Also, when someone is building a business as a solopreneur or just a couple of people who essentially are building a business for their livelihood and they're not looking for employees, they're not going to be as impacted by the labor market, obviously. At the other end of the spectrum, if we start moving a little bit from that kind of low capital environment, and we say, well, those businesses don't need too much in the way of bank financing. And then we move into in the middle. In the middle, we have things like retail, like restaurants and food businesses, the sort of businesses that we want to have on main streets, right? And for those businesses, it's sort of a mixed bag. One is that as people are returning from being at home and working from home and they're going back into public spaces, we have been seeing an increase in terms of people going into restaurants and demand improving. Now, that's a good thing, and we also have seen a lot of employment going into those sectors as well. And then, we can think of the fact that the inputs and ingredient costs are likely to increase. So although they have the cost side in terms of inputs, ingredients, foodstuffs, and they have the cost side in terms of the cost of their capital increasing, they also will see some increase in terms of demand, and that has been playing out. The other is construction businesses, right? So construction and trades businesses. A good friend of mine works as a general contractor, and we were talking a lot about the type of fuel costs that he goes through simply for equipment, not personally, just for equipment to get from one job site to the next. It's a big factor, right? And so when he's thinking about bidding jobs, he needs to put a timeline in terms of the bid so that after a particular point in time, that bid is no longer relevant and he might need to reevaluate it. And he needs to factor into it the cost of getting the equipment that distance to wherever it needs to go for that particular job. So there we see, again, a little bit of a mixed bag because there is some reliance in terms of capital and the cost of capital will be increasing. Also, we see that in terms of pricing has been increasing in order to match that the capital and labor cost increases, as well as materials. I think long before we hit the problems with the Ukraine, we saw a lot of increases in terms of lumber. And many people might remember when that first hit, there was a huge spike in terms of sheets of plywood, 2x4s, and so forth. Okay. The other thing that hopefully will be a benefit for construction businesses will be increased demand for services based on infrastructure spend through federal funding for physical infrastructure and the related subcontracts for that. Next, and I think the highest impact will be on local real estate development projects where we see that people may be looking at a logistics hub, or they might be looking at some distribution centers, the application of robotics. And when we look at those particular sites and we see what's happening in terms of the investment of capital into them, the calculus on which ones to proceed with will change based on the assumed interest rates in those particular project designs. So let's talk a little bit about digital experience. So a lot of times from a public sector side, we think of entrepreneurship based on our township, our borough, our city, our county. And we have in mind these particular lines and the boundaries of what we'd like to see within our patch. And for an entrepreneur, that typically is not relevant other than for compliance purposes and for tax purposes. So for digital experience, a lot of times entrepreneurs are more thinking about, well, how am I going to be driving sales in a digital business in particular, and how am I going to be reducing costs? So if we think about the types of experiences that entrepreneurs have currently online, I think is really helpful for us to think through in terms of what support services are relevant for them. So when we think of digital experience here and the types of existing entrepreneurial activity, we can think of things like Netflix and Zoom, right? We can think of things like other distance learning, Khan Academy. We can think of personalized financial services, branchless banking, right? Mobile banking. So there's an awful lot that's been happening already, as we know, in terms of entrepreneurship digitally, and which is leading to a demand for new services, right? So we need to be thinking about that in terms of what entrepreneurs are currently doing and the sort of support services that they're looking for. And so before I get into the demand for what they're looking for, I want to talk a little bit about the current support services that we already have available for them. Now I'm going to work a little bit from your right to the left. So I'm going to talk a little bit about the systemic changes and what we're seeing. So the first is about methodology. So we've, for years now, been moving from business planning and financial planning into design thinking, iterative design, lean startup, moving more towards quicker cycles of prototyping so that we have a stronger ability to understand what customer demand looks like. So again, rapid prototyping, getting a product in customers' hands or in a commercial customer's hands so that they can utilize it, and doing that much more quickly. So that's the methodology change. The other is more of a social change. There's much more of a focus now on things like ESG, so that's environment, society, governance. There's an awful lot going on in terms of sustainability, and people are really looking at what is the long-term impact of the business that I'm building or the business that I'm supporting. And then, related to all of this are the technology changes. So we're seeing a whole bunch of things happening around quantum computing, around big data, smart cities. There's a lot that's happening around fintech. We could talk about blockchain, cryptocurrencies. So lots of different changes in terms of the technology landscape. So what does that mean for our current services, and what is that opportunity space between what we currently are providing and what the demand for new services? So the first is education. If we think about education, we have cohort-based accelerator programs, and then we have point workshops on particular topics. Now, some people love going into in-place workshops and using them, which is great, but some people will just go onto YouTube, or they'll go onto another channel, another platform, and they'll get educational resources right from their computer, right? And so we know that that's already happening. The second is that we can think about personalized financial services. So if we think through, I can walk into the bank and apply for the loan, or I can talk with an angel investor group and try to get some input or advice or investment from an investor, that's great and it's not going away. But now more than ever, people are able to raise capital through a Zoom meeting, right? So it's not so much about where I am as opposed to who I know, right? The next thing on branchless banking is that for unsecured loans, consumer loans, particularly for folks with a higher credit score, it'll be much easier in order to apply for the loan right through the phone or right through their device, where it's not as important to have a relationship banker in the local branch that I walk into. The other, if we think about for a second, we covered money, right? And we covered some of the learning, right? Which is person to person. The other is about the other person-to-person type of communication that's relevant are sales, right? Sales-based conversations. And so that's also moving where it's less geographic specific and it's more about who I know and who I'm able to connect with and to schedule a conference call or a Zoom meeting. And it may not necessarily be so defined by where I'm sitting or where my office is. The other part has to do with compliance, right? So one of the biggest things that we see when we talk about a particular location is how quickly can I become compliant? How many licenses do I need to have? What do I need to do in terms of paying for zoning or for having equipment on site, how that's being taxed, Board of Health inspections. So what entrepreneurs essentially are looking for from municipal and state government is efficient compliance, right? The other thing is that entrepreneurs are looking to understand very quickly all the resources that are available from municipal and state agencies and to navigate through that quickly. I'll give you an example here in Greater Richmond. We have over 50 organizations, and we're a relatively small MSA, but we have over 50 organizations providing some sort of new business support services. So here I'm talking about things like classroom training, networking and meetup groups. It could be physical workspaces, co-working facilities, incubators. And then there's all the folks that are focused on early stage equity investments into those into newer and smaller businesses. So there's a huge range of organizations, and it can be difficult to navigate through all of that. So entrepreneurs essentially are looking for an easy way to navigate through that and efficiency in terms of being compliant with the regulations in that particular location. The last thing I'll mention is that in terms of the current services, we have, and I think probably the easiest way to think of this is that we have two sides of the equation, right? So on the one side, we have zoning and we have compliance and we have physical co-working and we have the physical infrastructure investments within a particular location. On the other side is much less place dependent. On the other side, we have the flow of things which we have right here in our pockets all the time. So here, it's much more about the flow of money. It's about the flow of insight and information between people. A lot more of that is cross-border. And then we have the flow of services now where designers, software developers, videographers, photographers, cryptographers are able to use their resources and be able to fulfill contracts on demand, on the fly, and don't necessarily need to work with someone locally. So I think it's really important to understand the distinction between what's really space-based and spatial versus what can be achieved or acquired through the internet.